traded. And I happened to be in the right place at the right time. You make your luck, but you got to be lucky. I was at a company called Radiance, and I got a call one day from a black box trader, not knowing
Waiting to go. These technical areas that we're putting out, those algorithms are going to that as sure as we're having this conversation. There's no doubt. They want to shake out the longs, and they want to get...
As central banks navigate the transition towards leaner balance sheets and reassess the optimal level of reserves, money markets are again
complaining over the phone how it takes him 43 milliseconds to send a trade.
We use our liquidity concepts to refine those zones and to know what requirements we need to see when price gets there to increase our strike rate, to increase our risk to reward. So that's
what retail traders perceive as robust market depth is frequently just a dynamic, programmatic illusion. When market volatility spikes, the order book often looks deeply populated with resting bids and asks. However, the moment a large institutional order hits the tape, those resting limits instantly vanish.
Traded. And I happened to be in the right place at the right time. You make your luck, but you got to be lucky. I was at a company called Radiance, and I got a call one day from a black box trader, not knowing what the hell a black box trader was, and had said, look, you know infrastructure. If I move my strategy from Kansas to New Jersey, can you co-locate me, meaning put me in a data center near the exchanges? And I'm like, yeah, of course we can do that.
What retail traders perceive as robust market depth is frequently just a dynamic, programmatic illusion. Algorithms flash orders onto the book, only to withdraw them the very microsecond they detect authentic execution pressure. Quantitative trading systems are programmed with strict risk parameters that monitor order flow velocity in real time. If the speed of incoming orders crosses a precise threshold, these machines pull their limits instantly.
Julia, I think when you take a look into the world, there is always something which is happening, and liquidity is always a hot topic in the way how it actually plays in. We just come out of the COVID-19, let's call it, we're still in the middle of it, maybe even the second wave. So I think it is one of those topics which actually really influences the market. But it could be any topic actually into it, which drives you to actually your liquidity pool to see how it is constructed, how it builds up, and what it actually the effects are of any event which actually sits into it.
The continuous flashing of temporary bids creates a dangerous, artificial sense of market stability. When macro events alter order flow, this phantom depth dissolves, leaving institutional buyers to execute against empty space. Algorithmic market makers prioritize risk avoidance over providing execution comfort to the market. The moment their systems spot high-volume institutional signals, they rapidly adjust their pricing models backward.
Now, I understand that's not how the market operates. We need to run liquidity in order to move the other way. And in this instance, the market respected liquidity and moved the other way. So that tells me that this move from high to low is a trap move to the downside, okay? And I want to be buying this price action back up, okay? So if there was buying opportunities in London, cool.
By retreating immediately when a genuine raid is initiated, the automated desk protects its own capital. The unfortunate consequence is that the executing trader suffers extreme slippage because the expected depth has vanished. To understand the mechanics of phantom liquidity, we must evaluate the core incentives of high-frequency desks. They operate strictly to test order book thresholds and capture high-probability spreads.
About liquidity that most YouTube videos miss. They just draw liquidity all over their charts and they say, this is why price went here, there, and everywhere, and it's just super discretionary and pretty useless. They don't give you a repeatable and systematic process that you need to use in your trading. They draw all of these fancy liquidity schematics, but
this discretionary, hyper-fast execution environment means that static order book models are completely obsolete. The structural reality is that depth is a fluctuating, highly strategic variable controlled by automated desks. Retail participants make trading decisions based on the visible bid-ask spread and the resting volume at each tick level. However, under high-frequency conditions, this depth is entirely unbinding.
position in the markets.
When we get to this edge, there's nobody here above us. And so if you think about what moves the market, what's most likely to happen as a trader is when volume comes into the market, it's going to be a massive change in structure because none of these prices are sticky. All of my executions rely on this idea of...
Please welcome this seven-figure trader, Forrest Knight. In this episode, Forrest breaks down his VPE strategy, using the volume profile to know exactly where to be positioned.
Algorithms have the freedom to pull bids without execution, leaving your order to match against a depleted book. The immediate result is that your entry is filled at a vastly worse price than displayed on your terminal. Algorithmic market makers utilize sophisticated predictive frameworks to pinpoint exactly where clusters of retail stop-loss orders sit. They systematically use this information to engineer highly efficient liquidity sweeps.
Written to go. These technical areas that we're putting out, those algorithms are going to that as sure as we're having this conversation. There's no doubt. They want to shake out the longs and they want to get people short. And what do the smart people do that are on the bottom of these algorithms that are scooping this stuff up? They're feeding into these people. That's what algorithms do. I'm able to take advantage of what they're giving me. Printing the money, man.
By intentionally pulling supported bids right before these stop-loss levels are hit, the algorithms for panic liquidations. This allows automated desks to fill their own inventory at steep discounts with minimal risk. This precise microcircuit orbital retreat is the primary reason why traditional breakout strategies fail with extreme regularity. While a breakout is designed to attract volume, supportive book depth disappears the moment velocity rises.
You're trading, your entire strategy revolves around chart patterns that lead to a breakout. Sometimes those breakouts are going to run and run and run. You're going to have a massive day. Other times it's going to feel like the market is out to get you and every breakout you buy is going to fail. Why is that? The answer to that question is ultimately going to be found in...
Tune in to deep dive into the trading mind at the deeper levels to understand how to become an elite trader.
Prop firm trading.
As soon as momentum traders buy the breakout, liquidity providers withdraw their limit orders on the ask side. This leaves the price structurally unsupported, causing it to fall straight back into a brutal stop-out trap. Algorithmic limit order books do not represent static commitments to trade, they represent real-time risk adjustments. If a provider senses a rapid change in order flow imbalance, they cancel their resting limits to protect their book.
Simple as possible. Liquidity describes the degree to which an asset can be bought or sold without affecting the market price. Once again, a pretty confusing explanation, so let's run through an example to simplify. Let's imagine you have a household item and you decide you want to sell it. So you walk into a gigantic hall filled with 1,000 people also looking to buy or sell that same item. That means 500 buyers and 500 sellers.
This rapid cancellation process makes liquidity highly volatile. During calm conditions, the market appears deep and deficient, but under stress, the depth shrinks to a small fraction of its normal size. Even the world's most stable sovereign and corporate debt markets are not immune to this phenomenon. The systematic transition to automated, high-frequency market making has made fixed income liquidity incredibly brittle under pressure.
Have altered trading, liquidity in securities markets, and the ways investors redeem holdings to get cash. Some of these developments are by design. Regulations imposing tighter restrictions on bank leverage have increased the cost of securities financing activities, even against low-risk securities such as treasuries, and have reduced incentives to maintain those activities and the portfolios behind them.
When macroeconomic stress hits, automated desks shut down their inventory-taking capabilities. The bid-ask spreads widen dramatically, causing chaotic, disorderly price changes in assets that are supposedly safe haven-esque. Algorithmic systems constantly create deceptive patterns on the chart to induce retail traders into taking positions early. These patterns serve as bait to build up a fresh pool of resting stop losses.
Just walking into the market like sheep walking to the slaughterhouse.
Traders believe they are buying at a strong, institutional support level, but they are actually placing their capital in a zone engineered to be swept. Once the stops are in place, the phantom support dissolves instantly. Tight regulatory standards over the past 2 decades have limited the capacity of traditional investment banks to hold risk on their balance sheets. In their place, automated high-frequency desks have become the primary source of day-to-day depth.
As central banks navigate the transition towards leaner balance sheets and reassess the optimal level of reserves, money markets are again.
This fundamental transition has altered how liquidity reacts during crises. Because these non-bank automated desks have no obligation to make orderly markets, they simply pull their limits the second risk levels rise. When central banks withdraw systemic reserves through monetary tightening, the total volume of real, high-quality collateral decreases. This baseline reduction makes the order books even more susceptible to sudden phantom pullbacks.
As you can read it here in the statement, that beginning in April, the committee will slow the pace of declining of its securities holding by reducing the monthly redemption cap on treasury securities from 25 billion US dollar to 5 billion US dollar. So basically what we can see that, well, it's not QE straight away, right?
As the absolute volume of baseline capital shrinks, the spreads of everyday financial instruments widen. The gaps in the order book become larger, leaving all participants highly exposed to sudden liquidity vacuums. Commercial banks and financial executives often point to calm, low volatility periods to argue that modern markets are functioning perfectly. However, this argument completely ignores the unstable nature of phantom liquidity.
Not heard liquidity as a problem from anybody, particularly for the small finance banks. It seemed as though they are going on a smooth path. They've not had a friction or a blip in the last 1 year. The service sector is showing very high appetite.
Having deep order books on a quiet trading day is of no benefit if those exact same bids disappear the moment a real geopolitical or macroeconomic shock hits the wire. When regional bond markets expand rapidly, they seem to offer immense opportunities for price discovery and low-cost execution. But when automated algorithms dominate the microstructure, this perceived liquidity is highly fragile.
Direct investment in the country. It has also reduced the crowding out of the domestic borrowers market, and it also has resulted into the entry of Kenya into the top 3 bond markets in sub-Saharan Africa. We're looking at a bond market of $15 billion, and this has increased liquidity tremendously. And of course, this means that opportunities for price discovery.
The sheer size of a bond market does not guarantee execution stability. If the primary market makers are algorithms programmed to pull back at the first sign of distress, the entire system can freeze up instantly. As macroeconomic policy rates rise, the cost of funding highly leveraged positions increases. This added pressure forces algorithmic market makers to tighten their risk parameters even further.
It's $15 billion, if not $20 billion to come in. And when this comes in, he's also sorted out the liquidity aspect which is necessary for a growing economy without getting too much pressure on the policy rates.
Would you like to tell him to ease that whole liquidity squeeze that happened?
When leverage is squeezed, market participants are forced to execute liquidations into an order book that is rapidly clearing out, resulting in a cascading downward spiral in asset valuation. During high-stress events, central banks often step in with massive liquidity injections to restore market confidence. Yet, while this stabilizes the macroeconomico, it does not solve the underlying microcircuitable issue.
The measures, most central banks, for example, the UAE, came out with very supportive measures, both in terms of liquidity, in terms of credit quality, in terms of capital. And what that really allowed us to do was it became obvious to investors, to those in the banking system, that this was not going to be a liquidity crisis.
Macro-level capital injections failed to change the fact that individual order books remained highly fragile. Traders still face massive slippage because market-making algorithms continue to prioritize microsecond risk avoidance. Economists frequently debate whether a sudden rating halt is caused by a genuine shortage of baseline capital or a microcircuitable liquidity crisis. In many cases, it is simply the rapid, automated withdrawal of phantom limits.
The liquidity shortage can be dealt with by lender of last resort. So in the case of the domestic banking crisis, the central bank is the lender of last resort. And if the central bank decides this is a liquidity crisis, then central bank can provide.
When algorithms withdraw their bids simultaneously across multiple venues, they create an artificial liquidity vacuum. This sudden collapse in depth can turn a minor short-term trading halt into a full-scale systemic crisis. Aggressive central bank rate cuts are historically deployed to boost economic activity and ease credit conditions. However, these interest rate adjustments cannot fix the fundamental microsecond vulnerabilities of electronic order books.
Monetary policy came out with a bang. I mean, we had aggressive rate cuts across the board. You look into any major EM economy, the rates went sharply lower and much lower than what they were in 2008 global financial crisis. Also in DM economies, they straight away went to zero. Rate cut for the first part. The second was aggressive quantitative easing. Balance sheet zoomed across the board. Much higher than what we had in the global financial crisis. Closer to $10 trillion of balance sheet expansion took place in the last 2 years only in the.
Lowering interest rates does not alter the code running the high-frequency algorithms. Even in a low-rate environment, the phantom limit orders in the order book will still dissolve the second real volatility is registered. Large-scale asset purchases by central banks are designed to flood the financial system with supportive capital. But by artificially suppressing yields, these policies encourage market makers to rely even more heavily on low-risk, high-velocity phantom orders.
At the zero lower bound, we then turn to unconventional measures to provide further accommodation, such as large-scale asset purchases and forward guidance about the federal funds rate. In the fall of 2012, with the unemployment rate hovering stubbornly at around 8% and core inflation steadily drifting lower than our 2% target, the Fed introduced open-ended asset purchases and later forward guidance that related federal.
Quantitative easing masks the structural instability of the market. The moment the central bank halts its asset purchases, the artificial depth evaporates, exposing the highly brittle nature of the remaining order book. Financial markets are globally interconnected, meaning that a microcircuitable liquidity collapse in one region can instantly trigger automated phantom withdrawals in another major financial hub halfway across the world.
Internal market and services, he has played a key role in defining Europe's response to the global financial crisis. The Commissioner will highlight the latest developments in the Eurozone area, including the proactive and historic measures that the European Union is currently undertaking in response to the challenges posed by the sovereign debt crisis.
When high-frequency systems detect an execution vacuum in Europe, their global risk management algorithms automatically pull limit orders in Asian markets like Tokyo, causing a synchronized, international evaporation of debt. Prolonged periods of abundant credit allow financial institutions to inflate their balance sheets. But this abundance of cheap capital does not create stable market-making depth. It simply increases the volume of highly flighty phantom capital.
And it's going to get worse. This is not over.
When the cheap credit cycle inevitably reverses, automated trading systems are the first to liquidate their positions. They cancel their limit orders across all books, exposing the complete lack of real, stable depth underneath. In unregulated or highly volatile digital asset spaces, the disappearance of phantom liquidity is even more dramatic. A sudden drop in the balance sheet quality of a single major player triggers an instantaneous withdrawal of all automated depth.
Was rocked by reports that Alameda Research, a trading firm affiliated with crypto exchange FTX, was in.
When a major firm collapses, algorithmic market makers do not stick around to absorb the selling pressure. They instantly pull their limits to zero, causing the asset prices to crash through the floor with massive, unavoidable slippage. The core mechanism behind phantom liquidity is latency arbitrage. High-frequency algorithms utilize ultra-low latency connections to detect your order as it travels across different execution venues, allowing them to cancel their limits before you arrive.
Complaining over the phone.
Because the automated desk operates in nanoseconds, they can easily pull their bids the moment they see your buy order hitting a public exchange. You are left trying to execute against a phantom that has already moved away. When a large institution executes a large parent order by breaking it into smaller child clips, They inevitably create information leakage. Algorithmic market makers analyze this microsecond flow to predict incoming pressure.
So it comes all back to what is your choice of liquidity you're using, how do you use it, and what is also the way how you actually really execute into the market. So how coherent is your liquidity? How do you actually aggressive, passive? How do you actually do that execution which you're actually looking for, and making sure you're actually having the right liquidity for you inside.
The second the algorithms detect the footprint of a large buyer, they cancel their resting limit orders. The resting liquidity evaporates, forcing the executing firm to buy at progressively higher and more unfavorable prices. Traditional technical analysts spend their time marking out support and resistance lines. What they fail to realize is that these chart boundaries are highly visible targets for algorithmic systems seeking to execute block trades.
High, Wednesday's low.
Algorithmic desks use resting retail stop losses as fuel for their own executions. They purposefully engineer price movements to sweep these zones, pulling back their own limit orders to let the stops trigger with maximum impact. Many traders rely on static, repeatable chart schematics to define where market makers will enter or exit. But in the microsecond domain of electronic markets, these rigid patterns are completely manipulated by dynamic algorithms.
We use our liquidity concepts to refine those zones and to know what requirements we need to see when price gets there to increase our strike rate, to increase our risk to reward. So that's what we're going to cover in this lesson today. So what actually is liquidity? Well, in its most simple terms, liquidity is just how much supply and demand there is in a market at every price level. On the left here, we have a very liquid market. So you can see that every single price level, there is a lot of volume on both sides of the market.
You cannot rely on static visual zones when the underlying liquidity is fluid. A support zone that looks incredibly strong on your chart can disappear in a single millisecond if the automated desks decide to pull their limits. Auction market theory shows that prices are determined by the interaction of active traders and passive limit orders. But when the passive depth is composed of high-frequency phantom limits, the auction process becomes highly unstable.
Talk about what the volume profile is, right? So what is the VP? The volume profile tells us how many people transacted at a price. So at the bottom, we often think of volume across time. So we might have 9 a.m. and 10 a.m., right? So we're looking at volume into the open. The market opens at the middle part, 9:30 a.m., right? So at 9 a.m., you might have this much volume.
High-frequency systems flash bids onto the book to gauge market reaction, but they have no intention of actually trading at those prices. If you attempt to hit those bids, the algorithm cancels them on repositions at a lower level. Algorithmic systems are programmed to search for high-density areas of liquidity to offset their own risk. They do this by driving prices toward major stop-loss pools while simultaneously clearing out the supportive limit book.
Focusing on the algorithms a very long time ago. It wasn't my will. I was an agent. Algorithms are 90% of the time is when you sell a failed breakdown. Those algorithms know that. You just know it. And I know that those algorithms are going to make that print. And they're programmed in to go to those strike prices. A lot of retail traders, they all make the same mistake. The important thing is for retail traders is
the resulting volatility isn't random, it is highly structured algorithmic exploration designed to force capitulation and secure risk. Free inventory for high-frequency desks. A support zone that looks incredibly strong on your chart can disappear in a single millisecond if the automated desks decide to pull their limits.